Thailand is dying. But at the exact same time, Google, Amazon, and Microsoft are pouring billions of dollars into this same country like it's the safest bet in Asia. This is the story of a country that pulled off one of the greatest economic comeback stories in modern history, but is now staring down a collapse that has nothing to do with a stock crash and everything to do with something far scarier: people simply disappearing. But here's the twist that makes this story impossible to look away from. While regular people are drowning in debt and babies stop being born, with shopping malls sit half empty, the biggest companies on earth are pouring billions of dollars into this same country. Somebody is wrong here. Either it's the economists calling this a dying nation, or it's the companies writing $5 billion checks. Stay with me, because by the end of this, you'll understand exactly why both of them might be right or wrong at the same time. The numbers that lying. Let's start with the ugly stuff, because there's a lot of it. By early 2026, the IMF had slashed its growth forecast for Thailand down to somewhere around 1.5 to 1.6% for the year. Compare that to Vietnam, growing near 7%. Indonesia, close to 5%. Even the Philippines, sitting comfortably above 4%. Thailand isn't just behind its neighbors, it's last in the entire region. Now here's where it gets strange. For most of 2025 and into early 2026, Thailand's inflation rate went negative. Prices on paper were falling for close to a year straight. Sounds nice, right? Cheaper groceries, cheaper rent. It's the opposite of good news. When prices stop rising, it usually means one brutal thing: nobody has enough money left to pay more. Businesses can't raise prices because customers are already stretched to their limit. Landlords can't raise rent. Wages stay frozen because there's no pressure pushing them up. Economists have a name for this trap, and it's the same one that swallowed Japan for 30 straight years starting in the 1990s. That brutal trap is a deflationary spiral, which economists also refer to as a liquidity trap or secular stagnation. Thailand is being warned, quite openly, that it's walking into the exact same hole. And underneath all of it sits the real killer: debt. Thai households are carrying debt close to 90% of the country's GDP, one of the highest ratios anywhere in Asia. People are spending everyday income just servicing loans, often on credit cards charging rates that would be illegal in most Western countries. Consumer lending has been shrinking for 4 quarters straight. The banking system has posted 6 consecutive quarters of negative loan growth, the longest stretch since the 2009 financial crisis. Then there's tourism, the industry that used to be Thailand's safety net no matter what else went wrong. In 2025, the country brought in around 33 million visitors, down more than 7% from the year before, and still nearly 20% below the almost 40 million who came before the pandemic. Chinese tourism, once the backbone of the industry, collapsed after safety scandals tied to scam compounds made international headlines. And even the tourists who do show up are spending far less. The average hotel or tour operator is still stuck earning less than half of what they made back in 2019. And then the stock market, maybe the most brutal signal of all, because that's where real global money lies. In 2025, Thailand's main stock index dropped 23%, making it the single worst-performing major market anywhere on the planet that year. Foreign investors pulled out well over 100 billion baht. Trading volume hit a 20-year low. A string of corporate scandals wiped out billions in shareholder trust. So if you stop the story right here, you'd walk away convinced Thailand is over. The money that disagrees. But here's the twist nobody's talking about. In April 2026, Moody's, one of the 3 biggest credit rating agencies on Earth, whose entire job is coldly pricing risk, upgraded Thailand's outlook from negative to stable. Their reasoning: easing trade tensions, structural reforms, and what they called sustained momentum in foreign direct investment. An agency that owes nobody a favorable opinion looked at the exact same economy everyone online had already buried and said, actually, this is stabilizing. And then the investment numbers came in. Thailand's Board of Investment revealed that foreign investment applications for 2025 hit somewhere around $60 billion, spread across more than 3,000 projects, a jump of roughly 67% from the year before. It was the highest total the board had recorded in its entire history. Where is this money actually going? Follow it, and it tells a completely different story than the one about a dying economy. Amazon committed $5 billion over 15 years to build its first cloud region in Thailand, with projections that it will add roughly $10 billion to Thai GDP and create around 11,000 jobs a year. Google followed with a billion-dollar cloud investment of its own, projecting over $40 billion in economic value over 5 years. Microsoft committed more than $1 billion specifically for cloud and AI infrastructure. And by May 2026, Thailand's investment board had approved a fresh wave of projects worth close to $29 billion, headlined by a data infrastructure expansion tied to TikTok's operations worth roughly $25 billion on its own. Add it up, and you're looking at over $15 billion of pure hyperscaler money landing in Thailand in under 2 years. For the first time in the country's history, digital infrastructure, not cars, not electronics, became the single biggest category of foreign investment. And it's not just data centers. Chinese electric vehicle makers have collectively poured billions into Thai manufacturing plants, building capacity for hundreds of thousands of vehicles a year. Chinese brands now control roughly 85% of Thailand's entire EV market. Thailand has quietly become a backdoor into Europe for cars built under Chinese ownership but shipped from Thai ports, dodging tariffs that would hit them elsewhere. Beneath all of that sits an even quieter story: circuit boards. Since 2022, well over 200 billion baht has poured into Thai printed circuit board manufacturing. Some of the biggest names in the world building components for AI servers have set up shop here, chasing capacity that didn't exist in the country a few years ago. So now you've got two totally different Thailands sitting on top of each other. One where families are drowning in debt, prices are frozen, tourists have stopped coming, and the stock market just had its worst year on record. And another one where the biggest tech companies on the planet are placing enormous, calculated bets, the kind of bets that only come after months of serious due diligence. Usually, when there's this big a gap between the headlines and the money wins. Because money doesn't care about a story. It only cares about what it can build and what it can earn. But there's one problem that no amount of foreign capital can fix. And it might be the darkest part of this entire story. Thailand is running out of people. Its fertility rate has collapsed to somewhere between 0.78 and 1 births per woman, depending on which estimate you trust, a number that, at the low end, sits below Japan's and even below South Korea's, two countries the entire world already treats as demographic disaster zones. In 2019, Thailand still gained population, roughly 600,000 births against 500,000 deaths. By 2025, that had flipped completely. Deaths were outpacing births by well over 100,000 people a year, and the gap is widening every year, not shrinking. Some provinces are recording so few births per month that maternity wards now have more staff than patients. Here's the part that should scare you. Japan went through this exact collapse, but Japan got rich first, building Toyota, Sony, an industrial base wealthy enough to fund elder care and pensions. South Korea got rich first too, with Samsung and an economy strong enough to attempt a real safety net. Thailand is aging before it ever finished getting rich. GDP per person sits around $7,000 versus over $30,000 in Japan and South Korea. The government pension many elderly Thais rely on is roughly $17 a month. Around 8 out of 10 elderly people depend on their own children just to survive. And the working-age share of the population is projected to shrink dramatically over the coming decades, meaning fewer taxpayers supporting more retirees every year. And this demographic collapse is already showing up somewhere very physical: real estate. Thailand is sitting on well over 400,000 unsold residential units nationwide, more than half of them concentrated in Bangkok alone. Hundreds of thousands of finished, empty concrete apartments with nobody inside them. Part of the reason is a decades-old law. Back in 1979, the government passed rules capping foreign ownership at 49% of any single building, reserving the other 51% for Thai citizens, specifically to protect locals from being priced out of their own housing market. It was a genuinely well-meaning law. But today, the average worker in Bangkok simply cannot afford the units built for that Thai-reserved portion. So developers are legally barred from selling that half to foreign buyers who actually have the cash, and locals who might want to buy can't get approved. Thai banks are reportedly rejecting a huge share of mortgage applications for units under the price point where the oversupply is worst, because banks know the underlying risk is simply too high in a market already drowning in debt. The ghost that still haunts this country. To understand why Thailand became so cautious, so debt-averse, so obsessed with foreign reserves, you have to go back to 1997. That was the year global hedge funds, most famously George Soros's fund, found a weakness in Thailand's currency system, which had guaranteed a fixed exchange rate to the US dollar. When the central bank ran out of dollars trying to defend that promise, the currency collapsed overnight. The value of the baht was cut roughly in half within days. Real estate companies went bankrupt. Poverty rates spiked. It took Thailand nearly a decade just to climb back to the economic output it had before the crash. You can still see the physical scar of that era standing in the Bangkok skyline today. A half-finished 49-story tower, abandoned mid-construction, that sat rotting in the sun for almost 30 years. A permanent monument to what happens when speculative money floods in and then vanishes. That trauma reshaped the entire national mindset. Thailand built up enormous foreign currency, reserves specifically, so no single trader could ever do that again. But in playing it that safe for that long, some analysts argue the country underinvested in the things that actually build long-term wealth: education, high-tech industry, productivity. So which Thailand is real? The one buried under debt, empty maternity wards and empty condo towers? Or the one that Google, Amazon, Microsoft, and Moody's just bet billions of dollars on? Maybe the honest answer is that they're both real, running in parallel on completely different tracks. The old Thailand, the one built on cheap tourism, cheap manufacturing, and a growing population, that Thailand really might be over. But a new Thailand, built on data centers, EV factories, and circuit boards for the AI age, is being constructed right alongside the wreckage of the old one. Whether that's enough to save a country that's running out of people before it ever finished getting rich, that's the question nobody can answer yet.